Okay, let's kick things off. When you start thinking about investing, about growing your money, it nearly always seems to come down to two main choices, doesn't it? Stocks or real estate.
Yeah, they're the big ones. And they feel so different fundamentally. One's about companies, the other's about, well, actual ground and buildings.
Exactly. And lots of people wrestle with this, so we've got some really good source material here comparing them. And our mission for this deep dive is basically to pull out the essentials.
Right, get to the core of it. What you really need to understand about the returns, the risks involved, and just the practical side of things.
Yeah, what's it actually like to invest in each? The aim isn't to say one is definitively better.
No, not at all. It's more about giving you the clarity, the insights, so you can figure out what makes sense for your situation, your goals.
Maybe it's one, maybe it's the other, maybe it's a mix. So the material covers the basics, returns, risks, pros and cons.
Yeah.
The whole 9 yards.
It does. Covers the overview, the numbers, the potential pitfalls, all that good stuff.
Okay, so let's start right there with the fundamentals. What's the absolute basic difference between buying a stock and buying, say, a house?
Well, at its simplest, buying stock means you own a tiny piece, a share of a company, like you become a part owner.
So a shareholder in Apple or Ford or whatever.
Exactly. Whereas with real estate, you're buying a physical thing, land, a building, something tangible you can, touch.
Right, something concrete. And the way you make money seems pretty different too.
Yeah, generally, stocks typically offer returns through two main avenues: appreciation, the stock price going up.
Because the company does well, or the market likes it.
Right. And dividends, which are basically the company sharing some of its profits directly with you, the shareholder.
Okay. And real estate.
With property, it's usually about collecting rent if it's an investment property. That gives you potential income, often steady.
Like a monthly cash flow?
Potentially, yes.
Yeah.
And then there's appreciation. Again, the hope that the property itself increases in value over time.
Got it. Now, one thing that immediately jumps out is the cost to get started. Stocks feel more accessible, right?
That's a really big point the source makes. You can often start buying stocks or even fractions of shares now with pretty small amounts of money.
A few $100, maybe less sometimes?
Yeah. Real estate, though, that usually needs a much bigger chunk of cash up front.
Okay.
We're talking down payments, closing costs.
And getting a mortgage, usually.
Exactly. Which brings us to a really key concept in real estate: leverage.
Ah, yes. Using borrowed money.
Right. A mortgage lets you control a much larger asset than your initial cash would normally allow. You might put down, say, 20%, but you control 100% of that property.
And you benefit from any appreciation on the whole property value, not just your down payment.
Precisely. That's very different from stocks where, unless you're using margin, which is complex and risky.
Right. Usually your $1,000 buys you $1,000 of stock.
Exactly. Leverage is a huge part of the real estate appeal for many.
And there's that tangible aspect too, isn't there?
Yeah.
People like owning something real.
Definitely. That sense of control, owning a physical asset you can see and manage, that's powerful for some investors. Stocks feel more abstract.
Although the source does mention REITs, right? As a way to invest in real estate, but more like a stock.
Good point. Yeah, real estate investment trusts, they trade on stock exchanges, so you get real estate exposure with stock-like liquidity. Kind of a hybrid.
Interesting. Okay, different field, different mechanics. But let's get to the big question. Performance. How do the returns compare historically?
Well, the source is careful here. It says comparing them directly is a bit like apples and oranges because different things drive their value.
Makes sense. But it gives some numbers, right?
It does. So looking at one recent period, 1992 to 2024, the S&P 500, which represents the broad stock market, averaged about 8.27% growth per year.
Okay.
But if you add in reinvested dividends, that average jumps to over 10% annually.
Wow, dividends make a big difference there. And housing over that same time.
The U.S. housing market, on average, grew slower, around 5.5% per year during that same 1992 to 2024 window.
So in that snapshot, stocks, especially with dividends, had a noticeable edge in growth.
In that specific time frame, yes. But interestingly, the source also looks further back, from 1972 to 2023, and compares equity REITs, those stock-like real estate investments, to the S&P 500.
Ah, okay. And how did that comparison play out?
Over that much longer period, equity REITs actually showed a higher average annual return, about 12.7% for REITs versus around 10.2% for the S&P 500.
Huh. So the real estate vehicle structured like a stock potentially outperformed the general stock market over the very long haul.
Potentially, yes, over that specific long stretch. Though the source does note that in the few years before it was written, stocks had generally done better than most REITs.
It really highlights how much the time frame matters and what specific type of investment you're looking at.
Absolutely. And one thing both views show clearly looking at the charts provided is that both stocks and real estate can take serious hits during recessions.
Oh yeah, you see those big dips around 2008 and again in 2020. Painful drops for both.
Definitely. Which naturally leads us into talking about risks. They both have them, but they're different kinds of risks.
Okay, let's unpack that. What are the key risks specific to real estate?
Well, first off, it requires a lot of homework. You need to understand the local market, property condition. It's not really a passive investment in the same way buying an index fund can be.
You can't just throw a dart at a map and buy a house.
Probably not advisable, no. A really big risk is illiquidity. It's just not easy to sell property quickly if you need the cash fast.
Right, you can't just click a button and sell your house in minutes like you can with stock. The source said you can't cash it in when you're in a bind.
Exactly. And then there are the operational risks, especially for rentals or flips, dealing with repairs, maintenance, finding and managing tenants. That takes time, money, and can be stressful.
Yeah, the leaky faucet at 2 a.m. problem. Or hiring property managers, which eats into profits.
Precisely. Those are very real considerations.
Okay, now what about the risks on the stock side?
Stocks face broader market risks, economic downturns, inflation woes, interest rate hikes from the Fed, policy changes, regulations.
More tied to the overall economy and sort of systemic factors.
Generally, yes. And they're known for volatility. Prices can swing pretty wildly based on company news, world events, or even just investor sentiment shifting.
Yeah, you see those big daily swings sometimes.
For sure. The source also points out investor-specific risks like not diversifying enough, putting all your eggs in one basket, basically.
If that one company or sector tanks, you're in trouble.
Right. And another risk is maybe focusing too much on just high-yield dividends and missing out on companies that are reinvesting for potentially higher growth down the line.
Different sets of worries for each. Let's drill down into the pros and cons list the source provides. Start with the advantages of real estate.
Okay, 4 main pros highlighted. First, that potential for passive income from rent we mentioned.
Steady cash flow potential.
Yep. Second, significant tax advantages. This is a big one. Things like deducting mortgage interest, property taxes, and especially depreciation for rental properties.
Depreciation is huge, right? It's a paper expense that lowers your taxable income.
It can be, yeah. Third, real estate is often seen as a hedge against inflation. The idea is you can potentially raise rents over time as costs go up.
Keeping pace with inflation.
Potentially, yes. And fourth, leverage. Using that borrowed money to control a larger asset.
Got it. Okay, potent advantages. What about the downsides, the cons of real estate?
Well, it definitely requires more work and time than just buying and holding stocks. It's hands-on.
Not truly passive for most people.
Not usually, no. It's expensive to get into, like we said, high initial costs. And it's illiquid, hard to sell quickly. Transaction costs are also much higher.
Closing costs, agent fees, yeah, those add up.
They do. And critically, appreciation isn't guaranteed. Property values can and sometimes do go down.
Okay, clear trade-offs, now flip it. What are the pros listed for stocks?
Stocks win big on liquidity. Super easy to buy and sell relatively quickly.
Click of a button, usually.
Pretty much. Diversification is also much easier and cheaper. You can spread your money across lots of different companies and sectors without needing huge amounts of capital.
Lower transaction fees, too, generally.
Much lower, typically. Yeah. And it's very straightforward to invest in stocks using tax-advantaged retirement accounts like your 401k or an IRA.
That's where most people probably have their primary stock exposure, actually.
Very common, yes. Easy access within those retirement structures.
And the cons for stocks.
Generally more volatile day-to-day or month-to-month compared to real estate prices. Selling for a profit usually means paying capital gains tax, unless it's in one of those tax-advantaged accounts.
Why, it's got to pay Uncle Sam.
And some stocks just don't do much for long periods. They can trade sideways for years. Plus, there's the emotional risk investors panicking and selling at the wrong time during a downturn.
Locking in losses instead of riding it out.
Yeah, I can see that.
It's a real behavioral finance challenge. Seeing them side by side like that is really helpful. Let's circle back to a couple of specific points. That leverage example, can you give us the numbers from the source again?
Yeah, it's a stark comparison. If you have, say, $25,000 in the stock market, assuming no margin, that $25,000 buys you Well, $25,000 worth of stock.
Simple enough, 1-to-1.
Right. But with real estate, that same $25,000 might be enough for a down payment on a property worth maybe $125,000, or potentially even more, depending on the loan.
So you're controlling an asset 5 times bigger than your cash investment in that example.
Exactly. That's the power and the risk of leverage. You magnify potential gains, but also potential losses if the value drops.
And you mentioned the tax benefits for real estate again. Depreciation, interest deductions.
Yes, the source really emphasizes those. Mortgage interest, property taxes are often deductible, and depreciation on the building itself lets you reduce your taxable rental income year after year, even though it's not cash out of your pocket at that moment.
That's a significant benefit for landlords. And the inflation hedge.
Just reinforcing that point, the ability to potentially increase rent over time helps protect the purchasing power of your investment income against rising general prices.
Makes sense. How about capital gains tax when you sell? Is that handled differently too?
It can be, yeah. A key difference, if you sell stock at a profit outside a retirement account, you owe capital gains tax for that year.
Standard procedure.
With an investment property, though, there's something called a 1031 exchange. If you sell one property and quickly reinvest the proceeds into buying another like-kind property.
Like selling one rental house to buy another, or maybe an apartment building.
Exactly, something similar. You can potentially defer paying capital gains taxes, not eliminate them forever, but push them down the road.
Oh, that's a huge advantage for people wanting to stay invested in real estate long term.
It allows them to keep more of their capital working for them instead of paying a chunk out in taxes each time they reposition.
The source also mentioned a rule of thumb, the 1% rule. What's that about?
Yeah, the 1% rule. It's just a quick screening guideline, really. It suggests that the gross monthly rent you collect should ideally be at least 1% of the property's purchase price.
So for a $200,000 house, you'd want to see at least $2,000 a month in rent.
That's the idea, yeah. It gives you a very rough first pass on whether the potential income might cover expenses and generate cash flow.
Is it realistic these days?
The source points out it came from an older, stricter 2% rule, and, well, in many high-cost markets today, hitting even 1% consistently can be really tough. Property prices have often outpaced rents.
So more of a guideline than a hard rule.
Definitely just a starting point for analysis, not a guarantee of a good investment.
This has been incredibly illuminating, laying out the differences, the potential upsides, the headaches. So when we pull it all together, what's the bottom line for someone listening, trying to decide?
I think the main takeaway from the material is that there's no single right answer. It's deeply personal. It really boils down to your finances, your comfort level with different kinds of risk.
Your goals, how much time you have.
Exactly. And your investment style, do you want to be hands-on or prefer something more passive? All those factors matter.
So no magic bullet.
No, but diversification comes up strongly, especially for long-term goals like retirement. The source frames real estate as potentially an ideal way to diversify a portfolio that might be mostly stocks.
Spreading the risk across different asset types.
Precisely. It can help smooth out the ride and potentially boost returns by not having all your eggs in one basket.
So it really isn't necessarily an either-or choice for many people.
Not at all. In fact, many savvy investors deliberately hold both stocks and real estate. They play different roles in a well-rounded strategy.
And if the idea of being a landlord just sounds awful,
then the source reminds us about REITs again. You get that real estate exposure, potentially the diversification benefits, but without the direct management hassles. You buy and sell them like stocks.
that's a great option to keep in mind. This comparison really paints a clear picture of the choices. So, as you, the listener, think about your own path, really consider these core concepts we've unpacked.
Yeah, think about liquidity needing quick access to cash versus owning something less easily sold. Think about control managing a physical asset versus owning shares in a company run by others.
Think about how you make money, dividends and stock growth, versus rent and property appreciation, maybe amplified by leverage.
And maybe most practically, think about the work involved. Are you looking for something mostly passive, like a diversified stock portfolio often can be?
Or are you willing and able to put in the time and effort that direct real estate ownership usually requires? How does that level of active involvement you're prepared for align with the returns you hope for and the risks you're comfortable taking on?